This conversation explores the topic of reverse mortgages, a financial instrument that is often misunderstood and underutilized. The hosts, Jim and Ryan, are joined by John, a mortgage broker, to discuss the benefits, eligibility criteria, and misconceptions surrounding reverse mortgages. They emphasize that reverse mortgages should be considered as a viable option, not just a last resort, for retirees who want to age in place and maintain financial flexibility. The conversation also touches on tax benefits, accessing capital, and the steps involved in setting up a reverse mortgage. Overall, the conversation aims to provide clarity and guidance for individuals considering reverse mortgages.
So, I guess tonight we're going to be talking about a financial instrument that it's been around, John, for a long time, but I think it's still somewhat unknown to a lot of people. And I think it's mysterious to some as well, including financial advisors. So I thought it'd be a good opportunity for us to maybe talk about reverse mortgages, what they are, who they might be suitable for, because they're not for everybody, obviously. And so Ryan and I would like to thank you for joining us tonight. And this is being recorded. For people who've registered for the session, they will receive an email with the recording after the session. And for people who weren't able to join us live, we will be converting this to a podcast as well. So it'll go out on our podcast as well as our YouTube channel and all of our social media platforms. Ryan, I think we've got a lot of social media platforms now. So
we do. So yeah. Have yet to start TikTok dancing yet, but I'm sure John can introduce us to some TikTok dances involving reverse mortgages. So
yeah. So let's introduce John. So for people who don't know John, John, partner at TVH Group, and I guess your title would be mortgage broker at Verico TVH Mortgages.
That's right.
Correct. And we have known each other for, I think we were talking about this yesterday, since 2007.
Yeah.
Right. So it's been a long time. So you put up with me for a very long time. So God bless you for that. But again, thank you for joining us this evening to talk about reverse mortgages. And I think, the first question really is, what is a reverse mortgage? So maybe you can kind of start things off with that.
Sure. A reverse mortgage is effectively a little bit different from a regular mortgage. And really the big difference is that when the charge is registered, you don't have to make ongoing payments. And I think that, while there are other differences, that's probably the number one difference, at least from a sort of, daily maintenance of the financing. And as a result, it occupies a very special space in the financial landscape. I think, understandably, it's the sort of thing that, confuses a lot of people because it's not sort of a typical mortgage. I think one of the issues with reverse mortgages in the past has been because of that sort of misinformation or misunderstanding around how the vehicle is used. A lot of people have shied away from it. But I think credit to the reverse mortgage people out there who work in the business. They've worked hard to try and help people understand how it works. And the fact of the matter is, like most financial products, used in the right way at the right time, it can be extremely beneficial.
Right. And how is it really different from people have taken out HELOCs in the past, variable rate mortgages? What are the main differences? Is the payment component the main difference, or are there some other differences that we want?
Like some of those other examples, if you get a regular mortgage, typically you have to select a term, a fixed rate, a variable rate, longer, shorter, etc. You do the same with reverse mortgages. So at the time that you take the mortgage, you will choose a term, right? Okay. Secondly, like with regular mortgages, you have an allowance of how much the mortgage is, and typically anything over and above the debt that you currently owe is going to be returned to you in equity. Same with a reverse mortgage. And because typically a reverse mortgage is going to be placed on a primary residence, that's generally a stipulation of any of the lenders who work with reverse mortgages. if you are in a position where you pull out equity from your property because it's a primary residence, it's also tax-free, just like if you were to pull equity with a regular mortgage through a primary residence.
Right. So there's some tax benefits then in going through the reverse mortgage
In
route.
many respects, reverse mortgages are very, very similar to regular mortgage debt instruments. Um, there is the difference, though, as I mentioned, of the payment. And what that means is, unlike a regular mortgage, a more standard mortgage, whereas you make a payment, typically there's a blending of both principal and interest, and therefore your balance decreases as you make payments. Because there are no regular payments with something like a reverse mortgage, then what actually happens is your balance will increase.
I guess it does a few things for people, right? It helps with cash flow because they're no longer making that payment. So it's a way of staying in their home, I suppose, instead of selling and renting and having that cash flow. They can remain in their home, not have that mortgage payment to worry about, and potentially also draw out some equity from the home on a tax-free basis and use that however they wish to, correct?
That's right. So again, we've done our share over the years. I I feel like we're seeing more demand for it for a couple of reasons. One, I think most people are aware of the graying of the population
Right.
being led by the baby boom generation. We are seeing simply more and more older people. And the reality is for most people, when they enter into retirement, they will see a decrease in their income, whether receiving pension or dividend income or living off of savings, their actual earned income will come down. And that sort of dovetails with the situation we've had over the last few years, where interest rates have come up appreciably. And given we are in a position where the government has mandated the stress test for most lenders, then what you get is a higher interest rate environment and an extra high bar with the stress test on top of that. So we are qualifying mortgages at roughly double what we would have been qualifying them a couple of years ago. So
Really?
if you're someone who is newly retired and
Mhm.
the bar to qualify has doubled, then you can see how traditional mortgages might be difficult for you.
Right.
A reverse mortgage at that point becomes something to look at.
Right. And I guess we talk from a tax point of view, again, we have access to the capital, the equity on a tax-free basis. There's a couple of ways that people can use again the equity that they take out. Where there would be tax, just to kind of clarify for people, is let's say you take that money and now you put it in the bank, for example, and you're earning interest on it, daily interest account, or you put it in a portfolio outside of a non-reg or outside of a registered product. So if it's non-registered, then you will be paying tax on the income that you earn on the investment. But in terms of the actual moving the funds out of taking the equity out, that doesn't trigger any tax. I just want to clear that up for people because I think sometimes that's a misunderstanding. They'll invest the money in the bank account and they're earning 3, 4, 5%, whatever it is, and they come back and say, well, I was told there was no tax on this, and there is on the investment component when you decide to take that money and put it elsewhere.
Unless it's a TFSA.
Unless it's a TFSA, right? Exactly. But with a lot of people, I'm assuming we're looking at some large numbers with the reverse mortgage, so they could probably put some in a TFSA, and even just while we're on this topic right now, some would ask me the question, well, should I also put money into an RSP from this reverse mortgage from the proceeds? And usually the answer is no, because now you're actually taking non-taxable money and converting it into taxable money, because then at some point when you take the money out of the RSP, you're going to be paying tax on that income. So better just to keep it non-reg or TFSA. There's some of the strategies that Ryan and I also assist our clients with in those situations. So in terms of the eligibility criteria for a reverse mortgage, clearly it's not for everybody. So maybe let's talk about, what do you need to be approved for a reverse mortgage, or to determine that it's suitable for someone.
So generally speaking, like any standard mortgage, there are conditions that need to be met in order to obtain the financing. Um, the big ones, however, typically center around things like age. So the older you are, the easier it is to obtain a larger amount from the home. And that's just simple statistics. If you're 60 and the idea is you would stay in the home for, let's say, 30 years till you live to, say, 90, then that's a different financial calculus than if you were 85 and expected to be in the home for, say, only 5 more years. Recognize the people who are advancing the loans are hoping to make some money, but traditionally for them, it's not until the end of the process where the property then is disposed of with a sale.
Right. So then how does it work for someone who is involved with a reverse mortgage? Because there's no payments that they're making. So I know that's attractive for a lot of people. How does the lender make money in this situation?
Effectively, it's at the end of the process. So, I mean, there are some more in-depth capital market machinations, if you will, but I think for most people, those don't hold much interest. The fact is they're going to swap out that debt in the market. And when the property is sold, their hope is that there's still equity left over. Now that equity essentially goes to the homeowner. So that's something that people sometimes have a bit of a misunderstanding about. The lender doesn't take over your home. It doesn't try to kick you out. I think that was sort of a common misconception early on, that people were potentially being forced out of their properties. That's not the way it works. Now, there are two things to be aware of, and this is how they make their money. One, the rates are typically a little bit higher. And that's just par for the course, because if you accept that their payoff is ultimately towards the tail end of the transaction, it's one of the ways they try to protect themselves. And then, secondly, it recognizes that, ultimately they are hoping that you leave the home sooner rather than later, because they would like there to be some equity left over. They don't want to end up in a position where the size of the loan ultimately outgrows the size of the equity remaining. But again, that's one of the ways they protect themselves with a slightly higher amount. And then that dovetails with typically a slightly lower loan to value. So if you are refinancing your existing home to pull equity, you could go up to as much as 80% of the value of the home. So if you had $1 million home, if it was appraised at $1 million, you could pull out up to $800,000. With a reverse mortgage, if it's that same $1 million home, the first consideration would be your age. So the older you are, potentially the more you could take out. However, the cap, the high end, would probably be somewhere around 50%. So recognize that you're not going to be able to take out as much. And again, that's how the lenders protect themselves over the longer term.
Right. And I know we talked about some of the benefits. Ryan, you and I are working with, clients who are retired, approaching retirement. We've talked in the past about, my Dignity program, which is insurance to help people if they have mobility issues when they're older, to avoid having to go to a home and have in-home care. This is something that I know people are definitely interested in, because I think when Ryan and I speak with clients, one of the questions we do ask is, do you plan on staying in your home? Is that your priority? Or are you looking at downsizing or moving away? And Ryan, I think you'd agree, most of the clients that we talk to say, if I can stay in my home, I'd prefer to stay in my home, right?
Yeah, definitely a comfort level for a lot of clients in doing so. And obviously, this is what sparked this conversation right now, because as you said, people are starting to get a little bit older, and there's a large generation that is going to make these decisions in the next 5, 10, 15 years, as they've already been doing, but more and more are going to be making these decisions. And we're asking the questions to make sure that people fully understand the options that they have. And, Jimmy, you and I were talking about this subject, and I wasn't fully of understanding of the concept, and again, the misconceptions that often happen with them. You hear lots of commercials about them, and often negativity comes from understanding. But to help clarify, bringing you, John, into this conversation to help not just myself, but many people out there that either have parents, they're aging and trying to make decisions of what the next step is. And it's definitely a big conversation that we've had more recently with quite a few clients. So glad we could clarify.
I think part of the reason that reverse mortgages have grown in terms of market share the way they have is because initially the thought process would see baby boomers essentially downsizing.
Yeah.
And while there's no doubt there has been some of that, the overwhelming majority prefer to age in place. And if you think about that from a more emotional aspect, it makes sense. If you've spent 40 years in a place and you're comfortable there and you have good neighbors and friends and you've raised a family there, the last thing you want to do more often than not is throw that all up in the air and start again somewhere else.
Mhm.
So, that I think has been a big driver of it. And again, I get more requests in the last few years alone, just with COVID and the like, as some people have opted to take sort of early retirement and like. I've had more people sort of reach out and touch base. And again, it's become something that I think will probably only grow in terms of what I will see from my existing client base and likely the market in general.
I don't know how many clients we'd work with who their initial plan, like you said, John, was to downsize, and then they would look at a smaller home, wanting to stay in the same neighborhood because they don't want to necessarily move away from the support network and so on and so forth. Their doctors usually are in the same neighborhood. So the bottom line is that they can't find a better price home, or maybe it's around the same price. So that downsizing aspect doesn't really work right now. So this does allow them to maintain their home ownership, stay in the neighborhood, that they've lived in for so many years. So it's a really good. There's a benefit for people who don't want to move away, and that seems to be happening more and more. I know in working with a lot of clients who romanticize about retiring at cottages, and once they approach or they're close to retirement age, they're thinking we're just going to sell our house and buy a cottage somewhere, and then they realize, oh, my knees are pretty bad, and I fell and broke my hip, and now I have issues, and I really physically can't manage a property like a cottage. So reality sets in, and then they default back to would love to stay where I'm at. Some people, they can afford to downsize into a condo, but they're not condo people, right? They still want to maintain living in their current home. So this is a tool that will allow them to do so. And also, John, or going to Ryan again, talking about mobility issues as well. It also helps them to, if they don't have the coverage that we try to encourage our clients to purchase, this is a way that they can finance some of the those expenses as well.
A question come up, a really great question is there like an ideal person, a scenario where this is kind of a right decision?
I'm always hesitant to try and paint, everyone with the same brush, because I do think, and you guys will appreciate this on the planning side, most situations are different. Again, any situation where there's a concern around the cash flow with a client who is appropriately aged, I think this is a tool they should be looking at and considering. Like you said, Jim, at the beginning, it may not be for everyone, but the reality is it can absolutely fix a lot of issues and give people a lot more flexibility with how they ultimately enter into, retirement, their older years, whatever you'd like to say. But again, I'm always hesitant to say, this is the exact sort of person, because I don't want people who may be a good fit sort of saying, oh gosh, maybe that's not for me because they don't fit the description.
Right.
Yeah.
And I know, one of the reasons why I think this is also attractive right now is, throughout the years, we have worked with clients and have always referred to their principal residence as a dead asset. So for people who just focused on paying down the mortgage as quickly as possible, not really building any other investments outside of their principal residence, I think anyone who's retiring now is recognizing that that home has become a dead asset. it's the majority of their wealth is tied into the home, specifically with Canadians and specifically with ones living around Toronto, GTA, and Vancouver and those regions. But this allows them to kind of untap that wealth that they can use for themselves personally. And something that came up yesterday, I think, John, in conversation, and I don't want anyone to think that this is well, we have to explore it a little bit further because we've talked with a few people and we'll probably refer to some lawyers as well to ask the question. But we talked about estate planning, right? So you have $1 million principal residence that has zero mortgage on that. The individual passes away. There's $1 million estate asset, and there's going to be probating and those issues. Where if there's a registered mortgage on title, so let's say they had a reverse mortgage of 500,000, then the net proceeds, and this is again, we're going to have to confirm this. I just want to make sure that we get the right answer. But if there is a $500,000 mortgage by way of a reverse mortgage, as an example, then the net amount, because those proceeds have to be paid off from the sale of the asset, then the net estate value would be 500,000 as an example. And then we talked about if the equity takeout, if some of that went into a segregated fund contract, for example, GIC doesn't have to be anything with risk. Well, anything that's placed in a segregated fund contract avoids probating and bypasses the estate. So this might actually be a strategy that, again, we're going to confirm. We're not certain at this point that everything lines up and fits. But this could be a strategy where people can save some issues from an estate planning point of view as well.
Yeah, and I know some people will look at something like a reverse mortgage and they'll exclude it from their consideration for exactly those reasons. You know, I would like to leave a legacy.
Yeah.
And hey, by all means, if that is a driving force in somebody's financial plan, but as you pointed out, it potentially does open up some avenues to leave perhaps a better legacy done differently, but something for us to dig into as well.
Yeah, for sure. And then, John, from accessing the capital, I know some providers in this space, do they provide, again, is it just a lump sum payout? Some of them will say that they can draw income from a reverse mortgage as tax-free income. Like, can you talk a little bit about the mechanics and the different options on how to access the capital?
So there are typically different ways to approach it, and some of that can be sort of laddered withdrawals, etc. I think in most instances, we figure there's probably greater range for the client if they withdraw the money up front.
Right.
The simple reason being that we can then turn it over to someone like yourself who will be able to work with the client in their specific plan. That being said, there are options that are available beyond just one single lump sum into the bank account. So I think, again, that's one of those where it's a little bit dependent on the person's own situation.
Yeah.
But there are a few things that could be done, and not taking it all in one big sort of fell swoop is one of those options.
Now, if they take it, in chunks over time, are they locked in terms of the cost, like the rate on their what they borrow, or does that change as they draw from?
Typically,
the
with
equity?
most financing, they will look to the market at that time. So that could potentially leave you open to some volatility.
Okay, so someone pulls out, call it $500,000. They decide that they want to take $50,000 a year in that scenario because there's no tax on that 50,000. However, the actual cost for each 50 block could be different. It's not locked in for the term of the reverse mortgage, so it could be higher on the next 50, could be lower. That's the unknown part of it.
And I think that's why, from a planning perspective, the suggestion is, we go with it at one time because then we can mitigate. It may be good, it may be bad. I know you and I have discussed before our disdain for trying to tell the future. It's pretty hard to do. So, sometimes working with a locked-in liability that you understand is simply the best way to go.
Right. And then with Ryan and I, in those situations, depending again, client need, client risk profile, we can again the range of investments that we could potentially use would go from a GIC, right, typical GIC, cashable GIC, to we can pensionize some of the funds, right, Ryan, using some other strategies that we have access to.
Yep, absolutely. Yeah, there's again, every case would be different, and we'd have to dig deeper and understand the full picture of every individual before we would do any recommendation. So, but
Yeah.
yeah, there would be a wide range of options for somebody when given that kind of lump sum. So,
Yeah. Okay. Now, John, would you say that, because I think this is the impression with a lot of people, that a reverse mortgage is like the last resort? Or would you say that a reverse mortgage should be one of many options to consider in combination of, or even just to consider it as an option?
I've I've been a mortgage broker for getting close to 20 years now, and
Yeah.
in the financial services, area for over 25. Um, and I think initially I viewed reverse mortgages far more as a last sort of option.
Yeah.
Um, I would say that in the last few years, I have a very different view of it. I think that it can provide a lot of flexibility. I think the biggest thing, and it's perhaps not even so much a financial consideration, it is more an emotional consideration. The
Mm.
ability to relieve yourself of the payments and the cash flow um, is such that it really is, you know, a significant comfort for a lot of people, to the
Mhm.
point of a dead asset. So you make your final mortgage payment on the day you die. Good for the bank. It's not really
All
good
right.
for you,
Yeah.
right? I don't see the sense in tying yourself so completely to something that you forego a reasonable retirement.
All right.
So, understanding that your property is an asset, and in Canada, given the amount of tax we pay, and given that your primary residence is essentially tax free, one of the best investments going, then absolutely it should not just be a last resort. If anything, especially once you hit the appropriate age, it's something you should be looking very closely at.
Yeah, I think there's some benefits again from an estate planning point of view, from a tax consideration, right, Ryan? Because I don't know how many clients do we sit down with who believe that they should put all their money into RSPs, they build the RSP portfolio, and
yeah,
then they hit retirement. And in a lot of cases, they're at a higher tax bracket in retirement because now they're being forced to draw on those registered assets. They have
yeah,
CPP and OAS. They might even have some kind of defined benefit pension plan. So in this instance, using a reverse mortgage strategy, we can also provide, a higher net income, and even defer the use of some of these other registered assets, right, until they're absolutely forced to draw from them.
yeah. Yeah, it's a great point that many clients look at the growing of their wealth and looking at it as a whole, but not realizing I've just deferred a bunch of tax to later on, and they're just looking at the big number and being like, "This is what I
Yeah.
get to live off of," but also that again, uh, that you don't have full control of it and how you take it in
All
retirement,
right.
and that
Mhm.
you're being taxed at. Uh, Quite often, most of the clients that we've run into are end up having to pay more tax in retirement
Yeah.
than they are right now when they're in their working years. So,
Yeah.
being able to strategize a little bit differently and have different avenues of income in retirement will
Mhm.
help alleviate that potential problem that they're going to have. So,
Yeah, for sure. Now, John, you and I have worked on a case that I just, in particular, I'm thinking about last year, with a client, a couple that you and I have started to work with when we started, or when we launched TVH. And I look at their situation where, um, principal residence in Toronto, strong value. They had a mortgage on it. Um, they were making payments on it. Cash flow was starting to become a bit of a challenge. I know in speaking with them from time to time, they would say things like, "No, we would really love to go on vacation. We just can't afford it at this point in time because of the cash flow." And they looked at the reverse mortgage, and we well, you put them in the reverse mortgage. I helped them with the equity takeout and setting those funds aside. And I know when I meet with them to go through my reviews with them, they always point out how they have no stress, financial stress, right? Because they no longer have that noose around their neck in terms of the monthly payment that they're making. Now, even more so, right? Like I can't imagine people who are approaching retirement having to deal with a mortgage renewal, for example, and some of their payments are going to be going up, or ones that were on variable rate mortgages where there was adjustable payments as well. To consider this as an option to eliminate that mortgage payment, because that tends to be a significant part of a household's expense from a cash flow point of view.
Well, especially if you look at the stats in recent years, there are sort of controlling amounts that we use in underwriting a mortgage. The ratios typically dictate how much of somebody's income they're allowed to put towards their cost of living. But the reality is, in many respects, that has been significantly pushed to the point where in some municipalities in the country, people are putting the better part of 50% of their gross income towards servicing their shelter debt.
Yeah.
So if you are someone who's coming up on retirement age and you're looking at what we're looking at now, which is not a small increase in payments, but likely a doubling or potentially even a trebling of what you've been paying, now
Right.
that's a real concern.
Yeah.
The one thing I would mention is there are still some requirements. You've got to maintain the home. Not that
Yeah.
people would not want to do that, obviously, but
Yeah.
it is something that's expected. And you do need to pay your municipal taxes, so that doesn't go away. But again, as a percentage of overall, monthly servicing for most people, that's quite small compared to the actual mortgage payment itself, especially
Right.
with current rates.
Okay. Now, if someone speaks with you, looking at this as an option, what are usually the steps for an individual once they've initiated a conversation with you to kind of walk through? So let's just walk everyone through the process
Sure.
of setting up a reverse mortgage.
It's pretty simple. We'd have a conversation about what it is they're looking to do. For some people, they would like to take a portion of the equity. For some people, they may have existing debt that they want to clear, but don't want more than that. For others, it may be a combination. So maybe they've got, like the couple we worked with last year, maybe they've got a relatively small mortgage relative to the value. So they'd like to clear that and make the cash flow issue go away. But
Right.
there's still equity left over, which they would like to pull out. Once I have an understanding of roughly where they fall within the appropriate scenarios that we can offer, then it's a conversation with the lenders. Typically, if you were to do sort of a more standard mortgage, it's a little bit more box lending. So in
Right.
the sense that, you sort of fit in the box and then you push the button and the other side will sort of say, okay, here's where we're at. With a reverse mortgage, there are a few more variables involved. So there is typically a little bit of back and forth, just to understand where we're going to be ultimately with the lender. And then you have a conversation with the client about the different options. But, in terms of the time it takes, et cetera, really no different from a regular mortgage. So if you've done a regular mortgage and you have sort of an expectation of timeline, et cetera, pretty much the same thing with reverse mortgage. Just takes about the same time, roughly the same level of review. They're just looking at slightly different things.
Are you looking at income as one of those things?
They do want to make sure that people have the ability to continue to maintain the property and service the property taxes. But for most people, even if all you're getting is CPP and OAS, they're not looking for people with six-figure incomes in retirement, because obviously if that was the case, we might not even be having the conversation about the mortgage in the first place. That being said, you can sometimes have a conversation about the amount of equity they're going to be pulling out. So this is where there's some back and forth with the lender.
Okay. But income really isn't as big of a factor as someone who's looking at a traditional mortgage.
Of the times that I've done a reverse mortgage, I have yet to come across a situation where income was any kind of a deciding factor.
Right. Okay. And I know we've said a lot of things tonight about reverse mortgages. Um, what would you say to the children of the parents who are considering this who may be against it? Because
Yeah,
that
well,
seems to happen a lot.
I think it would depend on the reasoning. The arguments are always important. Why are they against it? If the concern is, along some of the old school concerns with reverse mortgages, I don't want my parents to lose control of their home. I don't want them to get kicked out. Those are relatively easy to debunk. You can just have a straight conversation and help them understand that that's really not what we're talking about. If there's concern about their legacy,
Mhm.
and that's always a possible discussion. The reality is there's going to be a cost to help their parent in the interim.
Right.
So pay me now, pay me later. If they're at a point where they can't function because their mortgage payments are still too high, or they can't function, maybe their mortgage is gone, but they have nothing beyond their CPP and OAS. Well, in those instances, there's likely to be some sort of financial burden shouldered by, the children. So in
Right.
that instance, it's a function of how we can do it in a way where we can try and maintain ultimately the older generation's liberty and flexibility. Um, and if that means that they eat a little bit into a future gain, I would suggest most of the time people are okay with that. Because again, I think when you just explain there's going to be a cost one way or the other and someone's going to have to pay, most people don't want to have to foot the bill today. They'd
Right.
rather defer that cost, and that's what a reverse mortgage will allow them to do.
Right. Okay. I think this would be a good time because I think we're kind of coming down to the end of the session. So for anyone who's listening, if you have any questions, there's a chat option available. Just you're free to send us your questions through the chat. Ryan, any other things to add? Any other questions for John that you'd like to ask at this point?
I think it's really like, are there any tips that you'd consider for those people wanting to consider a reverse mortgage?
I,
Um,
I I think it is the sort of thing that, we should have a fulsome conversation about it. Unfortunately, it's not a silver bullet that necessarily fixes all of their problems. As Jim
Yeah.
pointed out, for
Yeah.
example, if you pull equity to earn income, it doesn't mean that that is magically tax-free income.
Yeah.
But I think the tip I would give people is, if they have not considered it to this point, that they should consider it, that they should have a conversation and really take a look at what it could potentially do for them. And as we'd said at the beginning, it may not be for everyone, but I know that I've seen examples over the previous years now that make me a firm believer that this can be an absolutely excellent choice for some people.
Right. Well, that's good. Well, I don't think we have any questions coming through. So, John, if someone does have any questions, they just want to consider it. What's the best way for them to reach you?
So email, phone call, we've got all that, of course, on the TVH website, but
Yep.
they can make a call to me at 416-488-0074. Again, 416-488-0074. Myself or one of my staff will answer, or jon@tvhgroup.ca. And again, shoot a note, we'll have a chat, and we'll go from there.
And if anyone has any questions for Ryan and I in regards to the reverse mortgages, you can contact us, but we're just going to send you over to John anyway. But you can reach us at financial@tvhgroup.ca, or call us at 647-727-4668. Or, as John said, just visit us on our TVH website, and you can connect with us through there. So, there's nothing else, I think we'll wind things up, guys. John, once again, really appreciate you joining us and sharing your wisdom and your knowledge
yeah.
with everything mortgage. Ryan, thank you again for joining us, and
Thank you.
we'll send this out by way of a podcast in the next little bit. So everyone have a good evening.
Take care, guys. Cheers.
Yeah.
Why is